What is going on, folks? Happy Liberation Day, April 2nd, 2025. My name is Hamilton. Just some random musings here before the Trump tariffs get announced. Talking through the price action over the last couple of days, what we're reasonably looking for inside of TTI, and a general game plan here heading in towards the back half of the day. I believe the tariffs are announced closer to the end of the day. And so I believe today is probably going to trade a lot like an FOMC day, where we're going to get some sort of established range and then not a lot of outside movement there, potentially a lot of volatility inside of that range. But realistically, probably not going to be a trending day in either direction. We are starting down today with the Qs down over 1%, the S&P 500 down just about 1%, small caps down over 1% as well, giving back a lot of what we gained yesterday. And unfortunately for breakout traders, momentum traders, in both directions, to the upside and downside, this has really been a grind in both directions. But obviously over the last couple of weeks or months at this point, the bias has been towards the bear side, right? There's just been more selling pressure than buying pressure. And the fact that we're continuing to trade on nearly every single major index below the 200-day moving average does not necessarily give me that conviction yet to be going long. This is an intermediate and a short-term downtrend. And if we start breaking these key levels that we set last year, which we are very close to doing, this starts to flip into a potential long-term downtrend. Inside of TTI, I don't care, we don't care about the opinions of others. We don't care about politics. We don't care about what the news says. We don't care about biases. We simply look at three defining features in the market: trend, relative strength, and momentum. And right now, if you are a technical trader and you're sitting here looking at a chart like the S&P 500 or the NASDAQ and you're going, yeah, this trend looks great, I don't know what the hell you're looking at. It's just that simple. Until the Qs get back up and over 497, this is not a long for us. It just isn't with any sort of size. We took a couple feelers over the last 2 weeks. Some of them worked, some of them didn't. We opened up an IPO range breakout yesterday with a very small size, priced to go to zero if you're buying options. Still trying to test the waters here just in case this Trump tariff Liberation Day stuff rockets the market. We have some exposure to the upside, not a lot though. Mostly though, we're sitting on cash. This is the defensive positioning type of trend until the Qs get up and over 497, until we're up and over the 200-day moving average. There's really no reason to be looking to get long growth stocks in particular with any sort of size. The S&P 500, that key level shifts upwards a little bit at 575. We got to get up and over the 200-day. It's just as simple as that. Paul Tudor Jones gave us arguably one of the most simple and effective tools in a technical trader's arsenal, and that's don't buy stuff under the 200-day moving average. Just don't do it. Things trending below the 200-day moving average tend to continue to trend below the 200-day moving average. Obviously, if you're looking to go long, that is disadvantageous. On the flip side, if you're looking to short, shorting things under the 200-day moving average tends to be an easier short than shorting things above the 200-day moving average. Think about the 200-day moving average not necessarily as a magical indicator, but it takes a lot of time and data to shift the slope of this thing. And as of right now, at least through the S&P 500 and the Qs, the slope is starting to shift potentially to a neutral slope instead of an up slope that we've been in for the last couple of years, and price is now trading below it. You have to give edge to the bears here. Having said that, the last couple of days particularly has been a very challenging environment to try to stick a short. Don't care what anybody says. Twitter and YouTube and other social media platforms will sit there and say, well, just short downtrends, buy a bunch of puts and you'll make a bunch of money. If you actually have money in the market and you are shorting the lows or into the hole, you have felt the nasty whipsaw effect over the last couple of days of those puts essentially going to zero. If you shorted late last week or Monday at the open, those puts have severely declined in premium, even if the underlying price is below where they were when you opened the puts. It's not as simple as just buying puts and waiting in a downtrend. You get a lot of whipsaw type action. You get bounces off of support. Bear markets are incredibly challenging regardless of which direction you're trading. Even if you're taking shorts, bear markets are harder to trade than bull markets. That's why a majority of the greats that you read about, and Market Wizards and all these other books, tell you that cash is a position. It doesn't sell subscriptions. It's not sexy. People aren't going to be lining up at the door and saying TTI is sitting in cash. They haven't lost X amount of percent this year. That's incredible. They just aren't. They're looking for opportunities to make a bunch of money. There are market environments where attacking the market is conducive, and there are market environments where sitting on the sidelines and waiting is conducive. And that's where we're at, right? We've thrown cash out into the market. Some of it's worked, some of it hasn't. So we're majority defensively positioned, waiting for the move, potentially coming at the end of the day. It was not a bad day yesterday, by the way. We had a pretty nice reversal, obviously opening up down today, which makes this even more difficult for people looking to short. Where do you short this potential move to the upside? Do you short it back at the 200-day moving average? Do you short it at the high of the day? Do you risk potentially gapping up the next day? It's very challenging. Something that we've looked at multiple times is this relationship between value versus growth. Over the last couple of weeks, value has just absolutely smoked growth, and particularly when we're looking into the bounces each day, right? Everybody is so ready to call the bottom. They want to have an excuse to go long stocks, and by all means, feel free. I'm never going to stop you. I'm never going to tell you you're stupid. It's your money. You can do whatever you want. If you want to buy downtrends, feel free. You're going to learn one way or the other that it's a very challenging way to make money in the market. What we're looking for, or one of the factors we're looking for, is growth to take control. We want growth to take the lead. In a bottoming formation in a strong bull market, you would assume that growth leads value. We're talking tech, consumer discretionary, communications. What we're seeing, even into the bounces, is that value is outperforming growth going back to February. For the last month and a half or 2 months now, value has smoked growth, and it continues to smoke growth. Every bounce in the market, we go and look at the growth versus value ratio, and we go, is this it? Is tech, communications, and consumer discretionary starting to lead? And they're not, at least not yet. You don't want to be buying bounces and sticking a flag and saying this is the bottom of the market until growth starts to outperform value again. If you get all excited about a bull market where utilities and consumer staples and energy is leading, feel free. If you're long those parts of the market and they're doing well, congratulations. But that doesn't necessarily scream primary trend is back up. This is a raging bull market. Get long the trader favorites, high beta stuff, software stocks, internet stocks. If those aren't performing well, I would tread very carefully before sticking your flag in the ground and saying this is the bottom. And we're just not there yet. We're seeing areas like energy continue to do well. I mean, this is the type of market environment that we're in. We talked about it yesterday. We've talked about it extensively inside of TTI. We have a couple energy positions on the books and they're doing well. But is this an environment where you are super excited to wake up every day and look at your portfolio if energy is the leading sector on the year? Most people probably not, but that's what the market is giving us. So you have a decision to make. Do you want to trade the market that's actually in front of you, or do you want to try to bend the market to your will? Because I know one of those ways is a surefire way to lose a bunch of money. You cannot force the market to do anything that you want it to do. You have to play the game. The market sets the rules. Play the game. Right now, energy is leading. You want uptrends, you want exposure to the long side, you got to be looking for things that are trending upwards. It's just that simple. Energy, going back multi-decades here, pressing up in towards a potential all-time high breakout. This is a technical trader's dream. It's frustrating because everybody obviously wants the energy sector to break out. We've been consolidating for the last 2 or 3 years here, but consolidating underneath an all-time high is not bad from a technical standpoint. Think about the volatility contraction here. Think about this as a spring being loaded in between your hands, and eventually that spring is going to fly, and all of a sudden these energy stocks are absolutely going to rip. Everybody's been waiting for this for the last couple of years. Technicians have been sitting here waiting. Above $100 on the XLE is a great opportunity to add exposure into a potential new secular breakout in energy stocks. Now, there have been opportunities over the last couple of years to own some energy stocks. Matter of fact, energy led off of the low back in March of 2020. Energy absolutely ripped. One of the craziest moves I've ever seen, particularly when oil went negative. But for the last couple of years, energy has been kind of a frustrating trade. Eventually, that will flip. This will change. We will probably break out here, and this will usher in a new secular breakout bull market in the energy sector. So have some names on your list that you like. We have names on our list that we like. And price of crude goes into this a lot as well. Price of crude is holding where it needs to hold. There's a lot of good stuff to look forward to from the energy sector. But once again, I want to point out, I'm not this eternal optimist when it comes to bull markets. There will be bear markets. There's opportunity everywhere. I totally get it. But most people probably aren't going to be super excited to own a portfolio filled with energy stocks in a quote unquote bull market. It's just not what we've been conditioned to over the last 15 years. But if you go back to 2000 to 2008, energy led the market, materials led the market, financials did well. For 8 years, tech underperformed. So there's absolutely an opportunity here for energy to outperform. I'm not here to tell you it will. I'm not here to try to guess that. But if this breaks out, I think it would be dumb not to have some sort of insurance exposure just in case. If you don't feel comfortable taking individual trades, you can leverage our trade ideas by signing up for our service, or you can simply own some exposure on one of these sector ETFs. XLE is very liquid. It's not too expensive. If you want some blanket exposure in energy, XLE is a great way to grab that. Another area of the market that I'm looking at for a potential leadership role, which has not come, is tech. Listen, guys, market's not going to continue to steam upwards with any sort of vigor until tech stops going down. Tech is the most important sector from a weighting standpoint in the most important indexes in the world. Just from a pure math standpoint, if tech doesn't do well, it's going to be very hard for the major indexes to do well. And then if you get a couple of these sectors starting to break down, which we're seeing right now, it's going to be impossible for the indexes to continue to move up over time. It's a math problem. Right now, tech looks terrible, trading below its 200-day moving average. The 200-day moving average is starting to arguably slope to the downside. You have bearish momentum coming in, not quite a bearish momentum regime yet, but very bad coming down into multi-month lows in tech. But it's not just tech. We have consumer discretionary, which is below its previous cycle high in 2021. Imagine this. We're finding support at a decent level, but we are now below where we were in 2021. This is an important problem for the market. Consumer discretionary, we're talking Tesla, we're talking Amazon, we're talking Home Depot, we're talking Lowe's, right? We're talking types of stocks where customers go and buy when they have a bunch of cash sitting around and they want to own a bunch of cool crap. These things are trading now below their 2021 highs. And once again, just like tech from a weighting standpoint, it's going to be very difficult for the market, at least the major market indexes, to continue their uptrend while the major components, the largest weighted things inside of these ETFs, are not participating. Last one here, which looks the best out of the three, communications. This is your Google, this is your Meta, this is your Disney, this is your Netflix, and to another extent, this is your Verizon, this is your AT&T, your legacy telecom providers. So I want to point something out. The two biggest names in XLC are Meta and Google. They control the trend of XLC just from a pure weighting standpoint. But is it reasonable to assume that XLC is going to outperform XLK and XLY in a drawdown? Potentially. Why? Because you have those legacy telecom names in there that are defensively positioned names. They have dividends. People tend to buy them in downturns because they're going to get paid to own those stocks, and they're lower volatility, meaning if those trends shift to the downside, which right now I believe AT&T and Verizon look pretty good actually, if they shift to the downside, they should lose less than the broader market. So XLC, by definition, by what's inside of the ETF itself, should hold up better than XLK and XLY. But once again, Google and Meta, which I believe Meta just flipped below its 200-day moving average. I think it reclaimed it actually. There it is. Tested its 200-day moving average. These are massive moves to the downside in the largest components in the communication sector. You need to have the largest components, at the very minimum, stop going down before these indexes catch a bid. Speaking of Mag 7 and these indexes, let's look at Mag 7. Mag 7 broke down, officially came down over 20% from its highs. It's impossible to imagine the S&P 500 and the Qs from a pure weighting standpoint catching a bid and continuing to scream higher when the largest components by weight are not contributing. It's almost impossible. And Mag 7 being down from an ETF standpoint, this is obviously all the Mag 7, but right now down 20%. I don't want to sit here and say technical bear market in Mag 7, but this particular ETF, this particular ticker, needs to stop going down. It's just that simple. And we're trading below a 200-day moving average. Just like the major indexes, we bounced off of it, we rejected it, starting to slope over. We are in a bearish momentum regime in MAG 7, at least through MAGs. It's important. This is something that you might not want to trade, but you can absolutely keep on your watch list, and you'll have a good idea of what the MAG 7 stocks are doing in total by looking at MAGs. Until this stops going down, it's going to be very challenging for the Qs and the S&P 500 to continue to stop continuing to go down. We need this particular area to flip. Okay, gold continues to shine. Broke up into all-time highs. I continue to think that there's a possibility here, particularly post this Trump tariff announcement today. I think gold's probably going to have a pullback here. You can see where we went long into GLD. We've been long GLD for a long time. If you're following me on Twitter, you saw the gold versus Bitcoin over the last year. You go back 1 year and gold has outperformed Bitcoin over the last year. Absolutely insane. And I don't know why right now the chart's not loading. TradingView loves to do that. But as of right now, we've been long gold since March of 2024. We took this breakout into all-time highs. We've added in 2 separate times, and we're into these all-time highs. We have exposure. I do think that there's going to be a pullback in gold. I don't know if the Trump tariffs are going to be the catalyst that kind of gives that. But what I'm looking for, particularly today, is once the Trump tariffs are announced, what does gold do? What does the dollar do? And what is the response right now? Not necessarily between value stocks, but growth stocks. What is the response with growth stocks? Do they squeeze higher? There's a lot of short interest on a lot of these big names right now. The market has done a very good job, obviously, in downtrends of kind of suckering in some shorts. Are they going to pay them out or not? I have no idea. What I do know, at least I'm speculating, is that MAG 7 stocks down over 20% since their peak. Markets are down over 10% since their peak. Markets have really priced in some really, really bad expectations for tariffs. And so unless Trump comes out and blows that expectation out of the water to the downside, I think it's going to be very hard for the market to capitulate, meaning drop down, 2-3% like a lot of people are expecting. I tend to think that it's going to take the other side of the trade. I think the market's going to rally post-Trump tariffs. I don't think they're going to be as bad as they are. But does that give us a clear signal to go long? I have no idea. Once again, we need those key levels to be broken to the upside in the Qs and the S&P. And I want to see what gold does. Does gold pull back? If growth stocks break out, if the Qs catch a bid, does gold pull back? I think that's reasonable expectations. And then what happens to gold miners? Gold miners are breaking out into multi-decade highs. Right? We have exposure in AEM. We have exposure in KGC. These are pressing up into all-time highs and 13-year highs. These are good trades. If GDX and gold pulls back, is there an opportunity to reload some of this stuff if you missed the original breakout? Yeah, I think there is. Right? These are good breakouts to potentially risk off of on pullbacks. I do think there's an opportunity for the market to give us that if it responds well post-Trump tariffs. What I think is going to be interesting is Trump is announcing these tariffs at the end of the day. Markets, I don't know if the markets are going to have any time. I saw 3 p.m. Eastern Standard Time. I just saw right before we hopped live, 4 p.m. Eastern Standard Time. If it's 4, we're going to have futures and we're going to have Bitcoin. Bitcoin's going to be a great barometer of how the markets are going to want to react towards the Trump announcement. If we look at BTC right now, stuck in a range over the last couple of weeks, or at this point months, just a nasty range. I still think there's a trip potentially down to the 70K range. That's kind of like my risk on, risk off level above 70K. I still like owning Bitcoin below 70K. I don't, but I haven't added a single dollar to the BTC position below the 200-day moving average. Matter of fact, I haven't owned anything since we broke 90K, or at least added into it. I still own it, but I haven't added into it. It's just as simple as trusting trends, trusting levels, buying the uptrends, playing defense when you need to, selling downtrends. If the Trump admin comes out at 4 and announces tariffs, Bitcoin is going to be a great barometer of how the overall market is going to take the news, how we're going to move. If you think about Bitcoin, it's essentially just a leveraged NASDAQ play. Think about it as a 2 to 3x play on QQQ. And that's how I'm going to look at it. If they do come out at 3 and give us kind of that rundown and we have that last power hour session, that will be interesting, because I think that what I'll be focused on and what we've talked about inside of TTI the last couple of days is the pros own the close. If you've never heard of that, ingrain that into your brain. The pros own the close. The close is the most important part of the day from a swing and position trading standpoint. If the market is buying the close, it generally tends to be a pretty good indicator of things to come from a trend perspective. And so if we come out at 3 p.m., the Trump tariffs come out, market rallies through the end of the day, I think that's going to be a very, very good sign. If the markets sell off into the end of the day, I think that's a very bad sign. If they don't come out at all and they wait till post-market close, 4 p.m.-ish, we'll look at Bitcoin and see how that thing's doing, just as a general idea. And by the way, tonight, we're running our April market review. We're going to wait for the tariff news to come out. Hopefully, the market starts to price it in a little bit so we have some fun stuff to talk about tonight. We're going to run our April market review tonight. If you're not a member of TTI, it's the most important session that we run during the entire month. We take a step back and over an hour to an hour and a half, we look at everything in the market on a weekly and a monthly time frame, all the sectors, all the industries. We look at sentiment. We look at risk on versus risk off. We look at all the major indexes, and then we pick through all of the different types of stocks that we think are going to do well, both to the long and short side over the next couple of months. We try to set up this April market review to be an opportunity for us to plan for the entire quarter. And so if you're inside of TTI, be there 7 p.m. Eastern Standard Time. It'll be very good. If you're not inside of TTI, I encourage you to check us out because it's the most important thing we do over the entire month. So that's kind of the game plan for today. I'm sitting on my hands. I'm not going to be opening anything up here. I think once again that today's action is going to be reminiscent of an FOMC day where we set some sort of opening range and then we probably stick within that range for a majority of the day. It could be volatile within that range, but I think the move comes post announcement of tariffs. I don't think it's going to come before. And so today's going to be a sit and wait game. Protect yourself. You don't need to have a bunch of cash in the market. I can't stress this enough. You're going to lose more money than you've ever lost before if you're making big bets on binary days like today. It's not a strategy that is replicable, right? You can't continue to go out there and try to guess the move in every binary play with a large amount of money every single time. You're going to lose eventually. And if you over leverage yourself, you could blow your account very easily. So defense is never a bad thing. As a matter of fact, in these types of situations, I think defense is preferred. Old adage in football, my Seahawks, early 2010s defense wins championships. Live to trade another day. Let's wait. If you're a swing trader or a position trader, let's wait to see how the market moves post-Trump tariffs. Try to reclaim these key levels in the Qs and the S&P. Look to see if growth is outperforming. If that's the case, we'll get long again. Talk about it tonight. If you're day trading, set your levels. It should be an okay day to day trade here with the volatility coming in. Just understand that we're probably going to be in a range day and not a trend day. Okay, my name is Hamilton. Here at the Trading Initiative, like this type of content, I would love a like. Let me know what you think. Are we up or down post-Trump tariffs? Is the Trump administration going to come out and say better or worse things than what the market is already expecting? Let me know, and I'll catch you guys tomorrow for the next morning stream. See ya.